Okay, let's dive into this. Welcome to today's explainer. We're going to unpack a genuinely fascinating question today. What does it actually mean to control a business under the incredibly dense and, let's be honest, often surprising rules of US GAAP? Because as you'll see, control isn't just about who holds the most shares. And buying a business, it's not just some simple receipt of assets. So together, we're going to uncover the two totally distinct sides of corporate control, diving deep into ASC 81010 and ASC 805.
Right, so here is our roadmap for today. Number 1, defining the VIE. Number 2, identifying the primary beneficiary. Number 3, the acquisition method. Number 4, purchase price allocation. And finally, number 5, goodwill and earnouts. Let's get right to it.
Section 1. Defining the VIE, or Variable Interest Entity.
So, this is where we explore a really fundamental GAAP concept. A lack of equity does not necessarily mean a lack of control. To put it simply, a variable interest entity, or VIE, is a company where the equity investors, as a group, are basically missing one or more of the typical hallmarks of a controlling financial interest. So what does that actually mean in practice? Well, it means the entity is a VIE if those equity investors lack enough equity at risk to finance operations without some kind of subordinated financial support. Or maybe they don't have control because they don't actually hold the voting power. Or perhaps they just don't absorb the expected losses or receive the residual returns. If literally any single one of those characteristics is missing, boom, you've got a VIE on your hands. It's kind of wild to think you can own an entity without actually having the voting power to run it, but hey, that's GAAP for you.
Now, there are 3 specific red flags or indicators you really need to watch out for here. First up, insufficient equity at risk. You want to keep a close eye on entities with super thin equity that are being propped up by parent guarantees. Second, a lack of power. Watch out for management agreements or operating agreements that completely override actual voting rights. And third, no loss or return exposure. A classic example to look for here, preferred equity arrangements with guaranteed returns. Basically, they completely insulate the equity holders from the actual risks of the business. Spot any of these, you absolutely must evaluate under ASC 810-10.
Let's anchor this theory to reality for a second. Where do we actually see VIEs out in the wild? Well, you'll find them in special purpose entities, or SPEs, which are often created for securitizations, just to isolate assets. You'll see them in entities controlled entirely by contracts. A super common example is franchisees. Think about it. The franchisor retains so much operational and financial control over the business that the franchisee's actual equity is basically purely nominal. And you also see this in certain joint ventures, where regardless of how the ownership is split up on paper, one partner is bearing substantially all of the economic risk.
Okay, moving to Section 2. Identifying the primary beneficiary.
So, if an entity is a VIE, who actually carries the burden of consolidation? Like, who literally has to put this VIE on their balance sheet? Well, that falls to the primary beneficiary. And the absolutely crucial point here is that being the primary beneficiary requires 2 things: power and economics. You must have the ability to direct the activities that most significantly affect the VIE's economic performance. And you must have the obligation to absorb losses or the right to receive benefits that could be significant to the VIE. Having power without significant economic exposure? Not enough. Having economic exposure without power? Also not enough. You absolutely 100% must have both.
Now, here is a massive surprise we found in the rules, so pay attention to this one. Do not rely strictly on the numbers. The analysis for this is highly qualitative. Ownership percentage alone simply does not determine the primary beneficiary. Because of the rules we just went over, a minority owner with a management agreement can actually be the primary beneficiary over a majority equity holder who has 0 decision-making power. I mean, it completely flips traditional ownership logic on its head. It's fascinating.
And remember, this status isn't just a set-it-and-forget-it deal. It's not permanent. Companies are strictly required to reperform the analysis whenever facts or circumstances change. Things like a change in contractual arrangements, equity ownership, or a shift in the VI's activities. Furthermore, the disclosure requirements are incredibly rigorous. Even if you aren't the primary beneficiary, if you hold a variable interest, you must disclose your maximum exposure to loss, the nature and size of the VI, and the carrying amounts of assets and liabilities. The big takeaway rule to remember here is that VI disclosure is required for all variable interest holders, not just the consolidating party.
All right, let's move to Track 2. Section 3, the acquisition method. Shifting gears from controlling without ownership, we're now looking at actively buying control. Under ASC 805, the acquisition method isn't just a suggestion, it is absolutely mandatory for all business combinations. There are literally no alternative methods allowed. The acquirer who obtains control of the acquiree must recognize all identifiable assets acquired and liabilities assumed at their fair value on the acquisition date. And whatever's left over, that residual amount is recognized as goodwill. Timing is everything here, specifically when it comes to two key concepts, the acquisition date and the measurement period. The acquisition date is typically the closing date when control actually transfers. But as you can imagine, assigning a fair value to an entire company's assets takes time. So GAAP allows a measurement period, up to 12 months actually, to finalize those fair value measurements. The crucial rule you need to know is that adjustments made during this measurement period, assuming they reflect new information about facts that already existed at the acquisition date, are recorded retroactively to the acquisition date. They are not booked as current period charges.
Section 4. Purchase Price Allocation Steps.
Now for the highly methodical part, breaking down the massive bill for the company you just bought. There are 4 strict steps to this process. Step 1 is identifying the acquirer. Step 2 is determining the exact acquisition date. Step 3 is where the heavy lifting happens, recognizing identifiable assets and liabilities at fair value. Interestingly, this includes your standard property, plant, and equipment, but also in-process R&D, which gets recognized immediately as an indefinite-lived intangible asset, rather than just being expensed. It's a nice little quirk of the rules. Step 3 also includes favorable contracts and intangible assets like customer relationships or technology, provided they meet either the separability criterion or the contractual legal criterion. Finally, Step 4 is recognizing that residual amount as goodwill, or in very rare cases, a bargain purchase gain. Of course, to calculate that residual, we have to know exactly what was paid, right? The consideration transferred. Now, the acquirer might transfer cash, which is simple enough to measure at its face amount, but they might also issue equity, giving the former owners minority status, or they might use contingent consideration, which we commonly know as earnouts, or even use previously held equity interests. All of these non-cash components absolutely must be meticulously measured at their fair value exactly on the acquisition date.
And this brilliantly illustrates the nuance of the rules, particularly regarding non-controlling interest, or NCI. At the acquisition date, the acquirer actually has a choice. They can use the full goodwill method, measuring NCI at fair value, which mathematically results in higher total goodwill. Or they can use the proportionate share method, measuring NCI strictly at its proportionate share of net identifiable assets, which results in lower goodwill. This one choice at the very beginning directly and permanently impacts the final goodwill calculation on the balance sheet.
Now you might be wondering, what happens if the fair value of the net identifiable assets is actually greater than the consideration transferred? This is what's called a bargain purchase. Well, the standard views this with extreme skepticism. Paying less than fair value for a business is exceedingly rare in the real world and, frankly, is highly likely to be a measurement error. Therefore, before you can book any sort of gain, there's a strict rule. You must first thoroughly reassess all identified assets, liabilities, and fair value measurements. Only if it is confirmed after that rigorous reassessment do you actually recognize that gain immediately in earnings.
Which brings us to Section 5, Goodwill and Earnouts.
Let's tackle the post-acquisition realities of that final step. We really need to look at the long-term impact that goodwill and earnouts have on the balance sheet long after the deal is closed and the ink is dry. Here is the golden rule for goodwill. For SEC registrants, goodwill is never amortized. This massive residual asset doesn't just slowly vanish from the balance sheet over time. Instead, it just sits there, and it must be tested for impairment at least annually at the reporting unit level. It becomes a permanent fixture of your balance sheet health, well, unless the underlying business value deteriorates. And then there are those earnouts, or contingent consideration. Their post-acquisition treatment depends entirely on how they are classified right at the start. If they're classified as equity, there is no remeasurement. It's permanently recorded at the acquisition date fair value. But, and this is a big but, if it's classified as a liability, it must be remeasured to fair value each reporting period, with those changes flowing straight through earnings. This creates a massive warning for businesses. If you have a deal with a large, liability-classified earnout and the acquired business swings wildly above or below its targets, it is going to create significant, sometimes shocking, and totally unexpected volatility on your income statement. For all the finance-minded learners out there, here is the satisfying visual payoff. This is how the entire business combination transaction physically balances out in the journal entry.
You are debiting the fair value of your property, plant, equipment, identified intangibles, and that residual goodwill. Against that, you're crediting the assumed liabilities, your cash consideration, equity issued, and the non-controlling interest. Seeing it laid out like this really just captures the entirety of ASC 805 in one neat, perfectly balanced package.
To wrap things up, let's quickly summarize the absolute golden rules we've uncovered today. From ASC 810-10, remember that just one VIE indicator triggers the entire analysis, and to be the primary beneficiary, you absolutely need both power and significant economic exposure. From ASC 05, the acquisition method is mandatory, goodwill is never amortized for public companies, and liability classified earnouts, yeah, they will create ongoing earnings volatility.
Which leaves us with this final thought. If control of an entity isn't just about the shares you own, and buying a business is just a hyper-specific fair value snapshot taken on one single day, what does a modern corporate balance sheet actually represent today? Think about it. It's not just a list of assets. It's a deeply complex map of economic exposure, qualitative power, and ongoing fair value estimates. Keep that in mind the next time you look at a company's financials. Thank you so much for joining this explainer, and keep asking the right questions.